Welcome back to the channel, guys. Thank you so much for joining today. If you are new here, my name is Josh, and on this channel, we're all about personal finance and investing. So if you guys like to hear about those sorts of things, make sure to hit that like button below and hit subscribe to support the channel. We really appreciate that. It goes a long way. But there is something on my mind that is even more important that I'm always thinking about. And if you're into finance or investing whatsoever, you've probably heard all about these different altcoins, these different cryptocurrencies that seem to be emerging like every single day, and how much money people are making in different coins, whether, this week it's been Ethereum, or it was SafeMoon, or it was Dogecoin, whatever it might be. It's weird to be a part of this because there are certain people who kind of have no investing background, or they don't really understand a ton about finance, but now all of a sudden they're making a ton of money because they got behind Elon Musk into Dogecoin, and now they're a millionaire, and they're looking at yachts and Lamborghinis and all this crazy stuff. And you're wondering, why, if I'm so much smarter and I'm working so much harder, am I not in that same spot? Well, I used to be in a position a lot like these people, okay? And I've come full way around. There are bunny rabbits, which we've all heard of, these little fluffy animals that bounce around from place to place, but I am more interested in money rabbits. And those are like people, like the guy that says like, oh, cannabis, crypto, all that different stuff in his Instagram bio, because he can't really commit to one passion. He's trying to get in on all these different things that can make him a millionaire overnight. That's what a money rabbit is, and I was one. I spent like the first 5 years, maybe a little less than that, maybe around 3 years of my investing journey, always trying to find the next home run. We hear these hilarious, like, hindsight biased examples of how, oh, if you would have put $1,000 into Amazon 20 years ago, you'd be worth X million now. It's just crazy how much we can look back at the past and think, oh, it was obvious to invest in Amazon and make all that money. When in reality, it's just our present mind not really being able to understand how much randomness was involved in that. So today, I want to attack this problem, okay? Because there's really two ways people can approach investing right now. I mean, there's many different ways people can approach investing, but I'm seeing two main ways. There's kind of this swing for the fences, try to get a 10x return, try to get a 100x return, make as much money as possible in the shortest amount of time type of investing and speculating that a lot of people are starting to get involved in, especially in 2020 and 2021. Whereas, the more mature and prudent and like your parents' advisor and all these different people always think about, well, maybe it's not necessarily about hitting it out of the park all the time. Maybe what we want is very modest returns or very modest gains, but compounded over a much longer period of time. So I kind of wanted to explore these two different ways of investing and where one might be appropriate and where one isn't appropriate, what you need to know before getting into both of these. So today I want to talk about a tale of two different investors, okay? We have one investor who actually, they're both going to contribute the exact same amount of money. Both investors are going to start with $10,000 and they're going to add $500 every single month, okay? Investor one, we're going to say, is the modest investor. They prefer to actually do things they enjoy in their life, whether they have passions or hobbies or sports they take part in. They don't want to spend their entire life thinking about their investments every single day. So what they do is they buy a very safe, reasonable, modest portfolio of index funds, maybe 60% stocks, 40% bonds, something that's relatively safe and simple and low cost and tax efficient. And maybe they get a 6% rate of return year over year over year over year on average, okay? Some years they're up, some years they're down, but over a long period of time, let's say 40 years in our example, they're gonna get a 6% rate of return. That is our modest investor. Now, let's move over to the Wall Street bets, the crazy kids, stacked with their stimulus checks, ready to throw it at any new altcoin. And we look at somebody in that same position. Let's say they have $10,000 and they're ready to shoot for the moon and swing for the fences, and they're gonna add $500 a month too, or $6,000 per year. So now investor two, though, doesn't get that modest 6% rate of return. They actually have a range of scenarios that is a lot more realistic to what we're looking at with shooting for the fences, which is if you can double your money overnight, what that means is you can probably also lose it overnight. It's this fantasy land you're living in if you really believe you can invest in something that can double but has no risk. You're either being scammed, you're being sold something, or you're just not really, you don't have enough experience to realize that isn't truth. And if it is something that's in front of you, it is probably not real, okay? So in this case, with investor number two, they have a 60% chance of gaining 30% a year and a 40% chance of losing 30% per year, okay? So that's something to think about. We have a 60% chance that we make a massive return, and we have a 40% chance that we lose a significant portion of our wealth, okay? And what I've done is I've actually created an Excel model that will project out where both of these investors get. And I wanna show you that right now. And I think the findings are pretty crazy. So up here in the green, we have the modest investor. And what I'm showing here is, the year and how much they have to start with and the rate of return and the addition they're making each year, as well as the balance at year end, okay? And what I do is I've hidden a lot of columns here just to make this simpler, but I show you year 1 to 10 and then year 20 and 30 and 40. And what we see is in the second portion where it says the money rabbit in red. Well, we have the same thing. It's the year, how much they have to start, how much they're adding. But okay, in this year, did we win or lose? Did our Dogecoin bet hit, or did it completely destroy us? Did our Safe Moon bet win, or did it not? Did this random stock we decided to get in because our cousin told us it was going to the moon, did it do well or did it not, okay? And what happens if yes is we get a positive 30%, and what happens if no is we get a negative 30%. And I've built the model so that it wins 60% of the time. I'm giving the money rabbit a benefit of the doubt because the reality is a 60% win rate is better than a lot of the world's best investors, okay? That's something to think about. And then at the end, we obviously see the balance. Now, every time I change any element of the model, let's say instead of, year 1, I put in the number 2, it changes all the figures, as you've seen. And in these yellow numbers highlighted, it shows us where we end up. We can choose to be the investor who takes kind of a boring, modest approach that isn't very fun to talk about with our friends. But what we find is that over time, if I run this over and over and over again, almost more often than not, we find that the modest investor wins. They come out ahead after a long period of time, and they do it in a much more delicate and gracious way. Whereas the investor who is always trying to get home runs is kind of all over the map. They're up like crazy one year and then they're down for this horrible period, and then they go way up and they tell all their friends how well they're doing, and then they lose it all again. But I want to talk a little bit more about the statistics, because what I've done is before the video, I actually ran through 10 different scenarios and I recorded what were the results, and I kind of want to walk through those results with you now. And by the way, I will share this. I can put a link in the description to show you. You guys can go around and play with this model and see how I built it. But let me talk about the results of the simulation. So the modest investor won 50% of the time. Okay, that's not crazy. So the modest investor actually ends up ahead half of the time, which is interesting because there was a 60% chance that the shoot for the fences investor would have won, right? But the problem is that when you lose money, it's harder to earn back. So even though that investor won 60% of the time, the 40% of the time where there was a loss, it hurt them proportionally more than the gain, if that makes sense, okay? That's kind of just the math of investment losses. So here's the crazy thing though. They both won an equal number of times, but when the modest investor won, they won by an average of 439%. And when the money rabbit won, they won by an average of 95%. So what we can see here is if you're the kind of person who always wants to shoot for the fences and is always looking for that next hot thing to invest in or get behind, there's a lot of things that are going to come to the fore and you're going to come to understand. One is that roller coaster ride might be so much that you almost cannot handle it. It's just too much volatility. Now, for the money rabbit, that's the life that they're going to live. They're not going to be able to plan for taxes or plan for a financial future because their numbers are going to be so sporadic. Someone who takes a more reasonable, modest approach can work with their accountant to see how can we reduce taxes next year because we have a general idea of where we'll be. They can think about how am I going to plan for retirement or buying a place at the lake or putting my kids through college, whatever their goal is. It is so much easier to achieve that if you have some semblance of a predictable rate of return that you're going to be seeing over time. So I think the end of the road here, guys, the big lesson is something from a guy named Naval Ravikant that I've talked about before. And he says, if you were to live 100 different lives, you want a process where you would be as successful as possible 100 out of 100 times. You don't want to live a life where you're ultimately successful in only 30 out of 100 scenarios, right? So what I mean by this is, if there's 100 of you, and there's 100 different lives that you live, if you're always shooting for the fences, sure, maybe 10 out of 100 might end up successful. But what we might want to do is think about how can we create a process in our life where there is some level of success that we would need to be fulfilled that we can guarantee. And this is where investing really comes around to what are the inputs versus the outputs. Everyone likes to think about returns. What are the big stories this year? What should I invest in? But maybe the thought should be, where can I be better? Where could I save more money? Where could I reduce fees? Where could I be more efficient with taxes? Think about the inputs on your end versus just trying to make the investments do all the work for you. So anyways, guys, thank you so much for watching this video. I hope this brought some things to light in terms of these two different strategies. And hey, at the end of the day, if you're the kind of person who has the risk tolerance to always be slapping down these massive bets that swing for the fences, you're gonna have a crazy ride, and maybe that's right for you. And I do think every single person out there should experiment with that. But I think it's clear with the data and the numbers that maybe the first priority should be a little bit of modesty. Anyways, thank you so much for watching this video. If you guys enjoy these whatsoever, make sure, like I said, hit that like button below, press subscribe, and turn on post notifications for more videos just like this one every single week. Until next time.